My dear students, today we are going to handle a new module, that is capital gain. In this video, I am giving you just an overview of capital gain. Detailed session will be handling in Google Classroom. First of all, what is capital gain? Capital gain can be defined as any profit or gain which is obtained due to the sale or transfer of a capital asset. That means profit or gains earned from the transfer of capital assets are assessed under the head capital gains. The following elements are essential for a transaction to assess whether the income is under capital gain or not. First condition, there should be a capital asset. Second one, it should be transferred by the taxpayer during the previous year. Third one, there should be profits or gain as a result of transfer. These are the conditions to be satisfied in order to charge the income under the head capital gain. First condition, there should be capital asset. Next one, it should be transferred by taxpayer during the previous year. Third one, there should be profit or gain as a result of transfer. Capital gain can be classified into two, short-term capital gain and long-term capital gain. Before that, we have to understand what do you mean by capital asset. Any kind of property held by an assessee, including movable, immovable, tangible or intangible, and include personal assets that may not be connected with business or profession of the assessee. Capital asset means property of any kind which may be movable, immovable, tangible or intangible and includes personal assets. They may or may not be related to the business of the assessee. Following assets cannot be considered as capital assets: stock in trade, consumable stores or raw materials held for the business or profession of the assessee, movable property held for personal use of taxpayer or for any member of the family dependent upon, specified gold bonds and special bearer bonds, agricultural land in India situated in rural area, deposit certificates issued under Gold Monetization Scheme 2015. Short-term capital assets. Capital asset held for not more than 36 months immediately prior to the date of transfer shall be deemed as short-term capital asset. Short-term capital asset means a capital asset held by an assessee for not more than 36 months immediately preceding the date of transfer. Following assets, the period shall be 12 months instead of 36 months to be considered as short-term capital assets: equity or preference shares, other listed securities, units of equity-oriented funds, units of UTI, zero coupon bonds. Here it is not 36 months but 12 months. The assets become long-term capital asset if held by assessee for a period of 24 months instead of 36 months. Those assets are unlisted shares of a company, Immovable property being land or building or both. Next, long-term capital assets. Any capital asset held by taxpayer for a period of more than 36 months immediately preceding the date of its transfer will be treated as long-term capital asset. Capital asset which is not a short-term capital asset is called long-term capital asset. In other words, we can say that a long-term capital asset means a capital asset held by an assessee for 36 months or more. In the case of shares in Indian company, listed securities, units of specified mutual funds, zero coupon bonds, the asset held by assessee for 12 months or more will become long-term capital asset. Equity or preference shares not listed and immovable property being land, building or both become long-term capital asset if it is held for 24 months. These are the exceptions. So what is short-term capital gain? Capital gain arising from the transfer of short-term capital asset is called short-term capital gain. Capital gain arising from the transfer of short-term capital asset is called short-term capital gain. This table explains how to calculate short-term capital gain. From sales value, we can deduct expenses incurred in due course of sale or transfer of assets, if any. When we deduct that expenses, we are getting net sale value. From net sale value, we can deduct cost of asset acquisition and cost of asset improvement, if any. Then we are getting short-term capital gain. So short-term capital gain means capital gain resulting from the transfer of short-term capital asset is called short-term capital gain. Next one, long-term capital gain. Capital gain arising from the transfer of long-term capital asset is called long-term capital gain. Capital gain arising from the transfer of long-term capital asset is called long-term capital gain. In order to compute long-term capital gain, we have to deduct expenses incurred wholly and exclusively in connection with transfer of capital asset. That means expenses such as brokerage, commission, advertisement expenses, etc. from full value of consideration. That means from sale value. Then we are getting net sale consideration. From net sale consideration, we have to deduct indexed cost of acquisition and indexed cost of improvement, if any. Then we are getting long-term capital gain. So cost inflation, indexation, here we are saying that indexed, not just cost of acquisition, but indexed cost of acquisition. So what do you mean by indexation? Indexation is the process of estimating the present value of the transferred asset on the basis of cost inflation index. Indexation means it is a process of estimating the present value of the transferred asset on the basis of cost inflation index. Cost inflation index means it is an index used to calculate the notional increase in the value of an asset due to Inflation. Cost inflation index is an index used to calculate the notional increase in the value of an asset due to inflation. This number, that means the cost inflation number, is important as it is used to arrive at inflation adjusted purchase price of assets and thereby long-term capital gain on it when it is sold. Okay, so in order to calculate long-term capital gain from net sale consideration, we have to deduct not just cost of acquisition and cost of improvement, we have to deduct indexed cost of acquisition and indexed cost of improvement. Okay, so long-term capital gain means the capital gain arising from the transfer of long-term capital asset is called long-term capital gain. Hope you understood these concepts. Detailed session we can handle in Google Classroom. Okay, thank you.